Welcome back. You're watching The Global Reset, and we're in conversation with William Lee as well as Jingye Pan to talk about what the upcoming July 9 deadline on U.S. tariffs could mean for the global trading order and, of course, for global markets as well. We just got Jingye's view on where the U.S. economy stands right now. Let me actually go across to William on this as well. William, we've discussed this in the past, that the U.S. economy has been amazingly resilient, right? But that's also because final tariffs haven't hit. I mean, and we've not seen an inflation shoot up. We don't know what manufacturers are going to do, whether they'll pass on the entire tariff increase or stomach some of it. So we haven't seen the full story. What's your sense of what the second half could look like as some of these trade deals start becoming a reality?
Well, let's remember that in this transition to the new global trading system, the whole idea of tariffs is to make people negotiate seriously. And so Donald Trump is saying, if you don't negotiate seriously and get a deal together, I'm just going to raise tariffs and to 100%, and then you'll have no market whatsoever. Now, remember, the U.S. is a relatively closed economy, and the reason why the CPI will likely see very little impact from any kind of a tariff is because the imports are only about 16% of all of GDP. And right now, the CPI is showing goods deflation in many areas, especially energy. And that has really compensated for a lot of the price increases that take place. And most of those price increases are domestic prices. They're service prices. They're non-traded goods prices. So tariffs so far have not shown up and likely will not show up much. Because we don't know sort of what the input-output matrix is, that where the imported intermediate goods that are used for production in the United States into final goods, how much of that is actually being used, how much we can find substitutes for those imported goods, and how clever businesses are in doing less with the more expensive stuff and trying to use more inexpensive inputs in their place. Now, in the short run, you're right, there's going to be very little substitution, but over the next 6 months to a year, how much inflation will it truly be? And that's what the Fed is trying to figure out. And remember, a tariff is a one-time price level jump, right? In order to have inflation continuing to rise, we're going to have successive rounds of this stuff. And if negotiations are successful and markets really open up and the U.S. is able to have access to our trading partners' domestic markets, we're going to see very few tariffs putting in place. We're going to see that basic 10% level of baseline tariffs, which President Trump has said is the price of entry into selling into the U.S. market. So I think there's a lot of uncertainty about inflation. In fact, I think there's almost no inflation possibilities. There is a price level jump possibility. How big that jump's going to be and how long it'll persist, that's the open question that Chair Powell is saying we got to wait and see the hard data. Because right now, if you look at the soft data and surveys, everyone and his mother-in-law is panicking about raising prices. We got to raise prices. We got to raise prices because our imports are going to be higher. Again, 16% of the U.S. economy will have higher prices. And how much will you raise prices if the demand for your goods start to ebb off? And
so William,
your high-priced stuff.
So William, I mean, this is interesting because it goes against the conventional narrative that we're otherwise hearing pretty much from commentators around the world that U.S. inflation could be a watch point. So I mean, will it cross 3.5%? Where do you see inflation as this transition plays out? Say, I mean, next 6 to 12 months.
The historic episode we have is that the tariffs from 2016, 2018 raised the CPI by about a quarter percentage point over 4 years. No, come on, that's measurement error.
And I guess that would make a compelling case for why Donald Trump has been really hounding, if I could use the word hounding, the Fed chair for cutting rates, right? William, in fact, coming back to the market, I mean, obviously you're making a very compelling case and offering good reason for the market doing what it's doing, and the market's gone to all-time highs. So are you saying perhaps little to no disruption of any kind because of tariffs in the next 6 months?
No. There will be disruptions because you can't transit from the existing trade system that we've had for 20, 30 years into a new one without disruption. This, by definition, will be huge amount of disruptions. How much of that will show up in inflation is the big question right now, especially short-term inflation that the Fed will have to react to. And I think Chair Powell is saying that there's really very little that he can really see from historical experience, but because we are in an unprecedented era where these threatened tariffs are so high, he doesn't know how long and the price level jump will persist. And I think that's the real question. If it persists for a year and goes away, then monetary policy should do nothing to counter it, because it takes about a year for monetary policy to take effect. And by the time it takes effect, the inflation's gone, right? The new level is achieved, and we're there. And I think that's why Chris Waller is saying that we really have room to drop interest rates right now, because we already have very high real interest rates historically in the United States. And if inflation really does achieve the Fed's 2% target, we easily have 100 basis points worth of cuts there.
Yeah. Jingye, just comment on this as well. What are you expecting from the Fed for the rest of this year, maybe going into next year?
Well, thank you, Suri. I think I do agree with the point that on inflation, there's high uncertainty. But for what it's worth, with the PMI, we do actually have the ability to just see a couple of months ahead. And currently, that number for the next round, around 3 to 4 months, is actually telling us that inflation in US could even spike to a range of around 4%. But what's important is that, with that being said, I think our prediction as well is that, like Willem has mentioned, it's going to be just a one-time effect. And, base effect is going to wear off. Eventually, we might see prices return. That is something that we don't know for sure. As of right now, our prediction is still putting inflation in the US at around 2.8% by the end of this year. So I think from that perspective, you are not going to see perhaps, a long-lasting inflationary pressure. But what we are trying to emphasize at this point is that there is going to be short-term volatility. And for the Fed to actually work through this, it's going to be challenging. But for what it is worth, we do actually expect the next move by the Fed to only actually take effect in December itself, when we do get a little bit more clarity, perhaps, to what is the situation, Sui.
Okay, got it. William, finally, before we wrap up, we're also halfway in the process of the big, beautiful, tax spending bill being cleared through Congress. It's already gone through the Senate. We'll see what happens in the House. Now, according to some estimates, the increase in the budgetary deficit could be, to some extent, maybe offset with whatever the U.S. is going to earn with these new tariffs. I don't know how that plays out, but your thoughts of how the passage of this bill kind of skews the landscape as the tariff negotiations are going on overseas for the U.S.
The key to the U.S. fiscal strategy, is to boost growth. And the elements that President Trump promised to put in place to boost growth is smaller government, lower taxes, and fewer regulation. And this package is the key part of that lower tax commitment, to say we're not going to allow tax to rise. We're going to keep taxes at the low level that he had put in place in his first administration. So I think that is really the key to this restructuring of the U.S. economy. If we can keep the government small, taxes low, and regulations as few as possible, we might be able to spur growth to the point where the debt to GDP ratio and the deficit GDP ratio will not rise as fast as being projected by CBO, because CBO natural rate of growth is somewhere about 1.8% growth. What Secretary Bessent has been talking about is the possibility of 2 to 3% growth, which is really out of the ballpark. But that depends upon having investment in the United States, having our partners invest in the United States, bring new technologies in, and develop the new technologies that we already have in the high tech areas that will boost productivity to the point where we can achieve these 2 and 3% type of growth numbers. If that's the case, then I think the fears that the bond markets are expressing about runaway deficits and how it's crowding out the demand for capital may not be as terrible as the fear mongers are suggesting. But the key is, will we get the investments in the United States? Will we get the growth? And will we get the government out of the way of these investments? And the key to that is fewer regulations, lower taxes, and smaller government.
Well, let's see if that bill is indeed passed by the 4th of July. And let's see if we get those final tariffs by the 9th of July. It promises to be a very, very interesting month for sure. Thank you very much, Jingye, as well as William, for joining in on this conversation. We hope to connect again with you as some of these events continue to unfold. Thank you for watching.
Passed.